Alright guys, so in today's video, I'm going to be taking you through 3 examples of what I class as an ICT A+ setup. If you like this video guys, let me know, and if you want this PDF, it's going to be in the link in the description in my free Discord. But without further ado guys, let's get into the video. Let's go. Alrighty, so in today's video, we're going to be going through what an A+ setup looks like if you're trading ICT concepts. Give you 3 examples from all sessions. Give you something to use and a framework to apply in the markets. A+ setup would be characterized as one that has multiple confluences. It's all about probability, and therefore you want to create a high chance or a high probability that the trade is going to play out in your favor. How do you do that? You look for key price signatures during key windows of time. After all guys, trading is simply just a probabilities game. It's as simple as that, right? You might win 50% of the time, 60, 70, 80, 90 here. There's a high chance of the trade developing in your favor, and you're stacking confluences. So for example, for me, if you're taking notes, this is what I personally look for. I look for price to be doing these things. Number 1, be delivering from a fair value gap. We'll talk about that. Number 2, hopefully if I can match price and time, I can use a macro or silver bullet. Number 3, I'm looking at the volume-based inversion fair value gaps. I'm looking at, if we create an inversion, how do we create that? Is there a lot of volume? Is it quite weak? In this third point here, you wouldn't just want price to create an inversion very weakly and then reject it. You want it to close above at a nice point, being able to give you confidence that the price wants to reverse or retrace. Inversion fair value gaps in themselves indicate that price may want to reverse or retrace, but number 3 is not enough by itself. Number 2 is not enough by itself. Number 1 is not enough by itself. An A+ setup is all these things or multiple things coming together to phrase that high probability trade setup. Fourth one is making sure I've got a clear target, ideally low resistance liquidity, and we'll get into some examples in a second. Number 5 here is quick to the target. I don't want price to muck around too much. If I've got low resistance like this, I've got price stepping down, and that's like your trend line liquidity. If we react during a macro from a fair value gap and create an inversion, I don't want price to muck around. I want price to get there quick, especially if it's low resistance liquidity. Keep that in mind. And the last point here is simply using discount premium, very basic concept. And we're going to now get into 3 examples of how you can actually apply these concepts and what I look for in terms of what is an A+ setup based on my rules and based on my models. So with that being said, let's get into the first illustration. And again, if you guys want this PDF, it's going to be free in the link down below. So if you haven't joined my free Discord, that's there. Obviously, I've got a premium section too, but the free section's down there. This will be uploaded within about 24 to 48 hours. So check that out. Now, illustration 1, I just want to talk about what we've got here. I've got a few things labeled. We'll get into the nitty and gritty of it. But this is an example of price delivering from a fair value gap. What time frame, Ruben? What time frame do I like to look at? I personally like to look at the 15-minute time frame for delivery from a fair value gap. That's what I like to look for. The market is only going to target 2 things, right? Number 1 is going to be liquidity at swing highs, and number 2 is going to be imbalances in the form of fair value gap. So if you have the example that I'm showing you right now, and you can see that we've got liquidity and we've got an imbalance, that makes a great target. Let's get back into it. So this here, this green box, that's a 15-minute busy. And I've marked out 2 points, point A, point B. Now, what is the significance of these 2 points, you might ask? Point A is where we sweep sell-side liquidity. What is important here is that we're sweeping liquidity inside of a fair value gap. That's important, write that down. We're sweeping liquidity inside of a fair value gap. We expect a reversal, but it's not enough just to enter from that. So again, this is a zone where I'm looking to take a trade once we sweep that liquidity. But then I ask myself a couple things, right? I ask myself, number 1, yes, we're in a key zone, of course. Are we in a macro? Is price showing me the reversal signatures I need to see inside this zone? If not, there's no trade. So you can look at price and go, great, we're in a level or a zone or a fair value gap or a time frame where I'm looking for something to happen. But if that something does not happen, it's not your trade to take. Price could move from here to here. People are going to be posting trades in your Discord and communities you're in, on YouTube, on social media. Look at this trade I just caught. Don't worry about that. Worry about your model and executing your model flawlessly. When it sets up, you take the trade. You manage your risk. When it doesn't set up, you wait for the setup to come to you. Wait for the market to show its hand. That is truly, truly important. So again, we sweep sell side here. Point B, that's important to me because this is buy side liquidity resting just below a sell side imbalance. Write that down. I like to either target liquidity that is low resistance or target liquidity that rests above or below a 15-minute fair value gap. So as we're going through these examples, guys, I want you to take your notes. I want you to ask questions if you have them in the comments below. But really keep in mind that it's all a probabilities game. You're putting yourself in the best position to succeed. That comes with patience. Patience and waiting is the hardest thing for any trader. Getting over the ego, fear, greed, balancing those things. That is what's going to make you profitable. That is what's going to make you successful. So we're targeting liquidity and imbalances, and now we're going to zoom in to point A to see if we're delivering or we're respecting this area, to see if we are, having those immediate reactions, to see what we're doing. So have a look here, right? These are the macros that are marked out. So this is macro number 1, this is macro number 2. I can probably zoom in a little bit here for you guys, just so you can see a little bit clearer about what's going on. That's the sell side point. And the question for you is, do we react immediately after sweeping the sell side? Look at that. Look at that immediate reaction. So we sweep sell, so we have that immediate reaction. We have that inversion fair value gap. And what's price do? It pushes up. That is a trade in itself. Now, we don't target the buy side till much later on, which is fine, but you don't need to take the price all the way there. That's a really important thing to note. One big part of my strategy is I might have a target that's all the way up here. I might only need to take the price 10, 15, 20, 30 handles, which might be up here. I expect to get there, but I don't expect to be 100% right. That's really important. Expect to be 50% right. If that 100% comes, even better, that's your runner. Here is most of your profits, that's your runner. If you don't like that entry, when price comes back down into this fair value gap, what do? We sweep this internal sell side right here. And if you pull a Fibonacci from this swing low to this swing high, we come back down into optimal trade entry. See how these things are starting to stack upon each other, guys. We've now got number 1, delivery from a 15-minute fair value gap. Number 2, sweeping of sell side inside that fair value gap. Number 3, macro. Number 4, inversion. Number 5, relative equal highs. Number 6, optimal trade entry. So essentially, if you took a long from here somewhere, after we invert these 2 fair value gaps, you've got about 7 things riding on that trade, supporting that price wants to push up and push up and push up. And that is what I consider an A+ setup. When you have so much confluence in the trade ideas, so many things, right, adding up, so many things adding up that the probability of the chance working against you is extremely low. And one thing you'll note, right, and you'll know this for yourself in your journals when you take trades, the trades that you wait for that are A+, they will often allow you to mitigate your stop loss and at least go to break even. The trades that you don't wait for, that are B or C setups, it won't be the case. It won't be the case. And what will happen there is you'll be waiting. You take a B+ setup or a C+ setup, and these are the setups that often obviously hit the stop loss, but they don't give you a chance to take a partial. How many times have you taken a trade, another trade, pushed and pushed, and you've hit your max loss, you've hit your max target in terms of max drawdown for the day, and you wait just 10 minutes to see what the market does, and what do you know? It develops and it forms your A+ model. But wait a sec, you've taken too many trades. Developing patience in the market is crucial. It's happened to me in the past, and I guarantee it's probably happened to you. You've waited just 10 more minutes and your ideal setup forms, but you can't take the trade. So waiting for A+ setups is it's a skill that takes time to practice. It takes time to learn. Focus on waiting, focus on developing patience, watching setups go by because that's not your model. And in time, you're going to develop a really strong mindset and be able to wait for that right moment to execute. Righty, let's have a look at illustration number 2. And this illustration is a typical combination of a sweep of liquidity, optimal trade entry, and also the terms quick and fast. Quick, fast. I don't want to be in a trade for 2 hours if I don't have to. I want to be in a trade in, out, 10, 20, 30 minutes maximum, done. This is where low resistance liquidity comes into play, and this is why I like these types of setups. Often, most of the time, they're going to be quick. Let's have a look. Now, looking at this example, there's a few things to talk about here. We'll talk about the different lines that are marked out just so you can refer to those in the future. And this is also from this week's and last week's price action. So having a look at price action here, this actually was from the Asian session, I believe, and this here is from the London session. So have a look at that one. Now, when you look at price, have a look at what we do in these key zones. What I explained to my Discord, if you're in from a Discord, you'd know this, right? I look for price to react from key zones and do important things in those key zones. What is one key zone? Optimal trade entry. So I've drawn a Fibonacci from this swing low to this swing high. That gives me these 2 blue lines. Those 2 blue lines are where I'm looking to see if price reacts from, because price is stepping down. Trend line liquidity. good target. We sweep sell side. Are we not in a macro too? Look, macro right there, right? So realistically, look what we've got going on. If I just zoom across here, we've got a few confluences. We've got all this trend line liquidity. We've come down, we've swept sell side inside of OTE, and then we've got our inversion. That's all it takes. That's all it takes to take a trade, right? Are we in a key level? Are we reacting in that key level? Do we have a clear target? And if you're in a time frame like a macro, even better. This is why I preach macros. This is why I'd say 90% of the time, most of my trades come from macros or around that macro time frame, using what the macro's done or the previous macro's done. And what do you know? How quick is it? Bang, bang, bang. Bang, bang, bang. Straight up. This is our target here. And this is where it comes to, accepting being 50% right and accepting taking partials. That's the biggest thing. Take partials, take your profits, pay yourself as a trader. I might have expected price to go to this high, but does it have to go to that high to make a profitable trade? It shouldn't. It shouldn't. Your model should allow flexibility. So let's assume you missed that. You're like, I don't like that. And you missed this trade. Price pushes up from OT of this range, from this low to this high. Then it comes back up again, sweeps this buy side liquidity. Now you've got a new range. So have a look. Swing high, swing low. That's the optimal trade entry of that swing high to that swing low. So we're working from this OTE to now this OTE. This is what I call playing the range, right? This is what I call playing the range. Up and then down, right? So we sweep buy side. We're in another macro now. So beautiful. And where is our target? Let me just zoom across here so you guys can see. That's your inversion fair value gap entry right there. Bang. Where do you target? This swing low. Why that swing low? Because again, the market likes to target two things: imbalances and also liquidity. Isn't that both things there? We've got an imbalance and liquidity. That is a low-hanging fruit target, and that is how you build a profitable model, by targeting these low-hanging fruit targets. And then if it wants to run, let it run. Don't expect the market to give you 100 handles, 50 handles every single day. Do not expect that. Not every day is going to be big like that. Some days are going to be playing the range. Other days are going to be trending. So if you haven't watched my previous video about market structure, check that out. And that's what I'll be looking at, right? I'll be looking at those things happening in the market and how to apply that and build a model and a strategy around that. Short from here, profit there. If you want to hold a runner, hold it to this low, but you don't expect it to get there. And now guess what I'll be doing from here? I'll be grabbing a Fibonacci from this swing low to this swing high. Price pulls back down into what? Optimal trade entry of this swing low to this swing high. And what do we expect? A potential bounce. Does it always happen? No, but this is a matter of waiting for your setup. Waiting to see if we have a reaction in that particular zone, executing flawlessly. So what you might notice with all these examples we've gone through so far is they require a few things. Number one, time is important. And number two, a clear drawn liquidity. It's all about, like I said, marking out these zones on your chart, whether it's a fair value gap, whether it's a macro time frame, whether it's a sweep liquidity, and looking to see if price reacts. Number one, it's going to react. Number two, it's not. Number one, you're then waiting for further signatures. Number two, if it doesn't react, there's no trade. Alrighty, so illustration number 3, let's get straight into it. Now, in this example, I just want to talk through this text here. If there is no nearby liquidity apart from what has just been swept, I expect a quick reaction. What do I mean by that? Well, see how you got all these swing highs here, swing highs, and price pushes up and sweeps that high. If on the 1 minute chart, I do this all the time, if on the 1 minute chart, there is nothing over here, I can't see anything over there. There's nothing there. There's no swing highs. And then I go to the 15-minute chart. There's nothing there. Well, guess what? I expect this to be a reaction point. So if I get a reaction after sweeping this swing high during a key time frame, that is going to be something I take. Simple as that. The same principle will apply if it's a previous week high, previous week low, or previous day high or previous day low. Keep that in mind. Again, we can pair this reaction with a macro and use an inversion fair value gap to enter. So the reason why this is an A+ setup is because if not now, then when? That's kind of what I call this model. If not now, then when? If it's not going to react here, then when is it going to react? It's going to, go to external liquidity way up on the hour time frame, the daily time frame. See, I'm not interested in chasing price. So by this point, if you don't react from here, then I wouldn't take the trade. I'd expect price to be going up, all the way to external liquidity, daily levels, 4-hour levels, 1-hour levels. That's outside of my scope. It's outside of my model. It's not my trade to take. And that's how you keep it nice and simple. So if not now, then when is what this model is called. And if we look at a further example, you can see, right, we sweep that buy side, That is your macro. It's just random, right? This is why I love macros. It gives you time to focus on. If not now, then when? Sweet buy side liquidity. We've got a macro, and here is our inversion fair value gap. Bang. Could you enter there? Yes, but your stop's going to be way too long. So what you're going to have to do is wait for the pullback, and ideally, here's how you implement this A plus trade. You wait for the second inversion gap right here, and you can enter here and put a really tight stop above that high. Why can you do that now? Why wouldn't I have a stop up here? Well, it's way too much. But now you've created an order block, and you've created another inversion fair value gap. You're going to read price as it's printing. Have ideas in mind. Have these things that you might want to anticipate happening. But if it happens, it happens. If it doesn't, it doesn't. So you might be like, yep, I'm looking for a reaction after sweeping this high. You get that. It's not the end of the world there. Don't FOMO into the trade. Just wait to see what happens. Price pulls back. You can then grab a Fibonacci from that high to that low. When it pulls back above equilibrium, that could be a position in. And then when you keep going through, once this gets inverted here, you can take another trade or pyramid into the position. Where do you target? This low, this low, this low, this low. Do I expect the extreme low to get swept? Hopefully, but does it have to? No. Pay yourself as a trader on the way down or on the way up. That's really, really important. So to conclude this video, guys, I hope you got something out of this video. If you're looking for A+ setups, focus on time. Focus on key levels the market can react. Where are those key levels? From a fair value gap, from optimal trade entry, and ideally during a macro.